Today, we're going to unpack something that is, honestly, just absolutely fascinating. You see, the fall of Lehman Brothers wasn't just a massive bankruptcy. When financial experts and forensic examiners finally got in there and dug through the wreckage, they revealed something wild. It was an elaborate illusion. And today, we're going to see exactly how they pulled off this fatal disappearing act. $639 billion. I mean, just take a second to process that. That is the staggering scale of assets Lehman Brothers possessed the very moment they vanished into bankruptcy. It's almost impossible to wrap your head around that much money just evaporating overnight. But to understand how this happened, experts tell us we kind of have to stop looking at Lehman Brothers as a traditional bank. We have to start looking at it as a colossal magic trick, a trick that crucially required an audience completely willing to look the other way.
Okay, Section 1, a monument built on sand, the rise and the gorilla.
Now, Lehman wasn't some flash in the pan. Not at all. They actually started way back in 1850 as a dry goods store down in Alabama, selling cotton. They eventually moved up to Wall Street, they survived the Civil War, and they even weathered the Great Crash of 1929, which, by the way, wiped out half of American finance. For over a century, this place was a literal monument to American capitalism. But the pivot point, the real shift, came in 1994. That's when a guy named Dick Fuld took over as CEO, and the firm completely transformed. It went from this sleepy, prestigious bond shop into a reckless, high-risk, high-reward powerhouse.
They literally called him the gorilla of Wall Street. And for a while, Fuld looked like an absolute genius. The stock was soaring, the bonuses were frankly obscene, and he pushed the firm heavily into mortgages and these incredibly exotic derivatives that almost nobody fully understood. But when financial historians and risk experts later analyzed Lehman's internal culture, they pointed out a massive, fatal flaw. Fuld ran the firm like a cult. Dissenting voices, risk managers, they were completely exiled. If you dared to question the mortgage strategy, you were shown the door. Lehman was making these massive bets with other people's money, and they had entirely dismantled their internal checks and balances.
Moving on to Section 2, Repo 105, the magic trick.
So how exactly do you make billions of dollars of toxic debt just disappear? Well, forensic accountants found that Lehman exploited a tiny loophole discovered back in 2001 called Repo 105. And it's an accounting trick so incredibly absurd it almost sounds like a joke. The rule basically allowed a firm to classify a short-term loan as a legitimate sale simply by transferring assets at a discount of more than 5%.
Let's actually walk through the mechanics of this step by step. Step 1. Lehman would quote-unquote sell assets to another bank for slightly less than they were worth, say taking $100 in cash for assets that were actually worth $105. Step 2. Because of that gap of more than 5%, accounting rules let Lehman book this as a real sale. Boom. The toxic assets completely vanish from their balance sheet. Step 3. Lehman takes that cash and pays down its debt, suddenly making their leverage ratio look totally healthy just in time for their quarterly public reports. And finally, Step 4, a few days after the report comes out, they borrow the money back and repurchase those exact same assets. The assets never really left, the risk never changed, but for 3 magical days, every single quarter, Lehman looked perfectly solvent.
This number right here just perfectly illustrates the sheer audacity of this fraud. $50 billion. In just the second quarter of 2008 alone, Lehman used Repo 105 to move $50 billion right off its books. And they did this repeatedly. We're not talking about some minor rounding error here. Experts made it clear this was an industrial-scale manipulation of their financial reality.
But as we know, a magic trick only works if no one is looking too closely. And the people whose literal job was to look closely, they simply chose not to. A Lehman vice president actually explicitly warned internally that this practice presented massive reputational risk if it ever got out. But the external experts willfully ignored it. Lehman's auditor for over a decade, Ernst & Young, knew all about the trick. They signed off on the financials anyway, and they happily collected their fees.
Section 3. 72 hours to save Lehman. Okay, so the illusion finally starts to shatter. By Friday, September 12th, Lehman's stock had plummeted 75% in a single week. The entire subprime mortgage market was imploding. So Treasury Secretary Hank Paulson summons Wall Street CEOs and delivers a very blunt message. Lehman is not too big to fail, and there will be no government bailout. You guys have the weekend to fix this. Saturday turns into this frantic, desperate search for buyers. But by Sunday, the lifelines vanish.
And at exactly 11:59 p.m., Lehman files for the largest bankruptcy in American history.
So why did those lifelines fail? Well, Bank of America took one look at the books, realized Lehman's assets were so unbelievably toxic that buying them would sink their own ship, and they stalled. Then Barclays emerged as a potential savior. They actually agreed to buy Lehman. For a brief moment, the 158-year-old bank was saved. But then UK regulators stepped in and blocked the deal, saying it required a shareholder vote that couldn't happen until Tuesday. Hank Paulson absolutely refused to provide a bridge loan to cover that gap. No government guarantee. And just like that, the deals died.
Section 4. The Global Financial Detonation.
When Monday morning hit, it was catastrophic. Lehman's exotic derivatives were woven into the invisible infrastructure of global finance like a giant spiderweb. Pulling that thread made the whole thing collapse. AIJ faced immediate ruin because they had insured half the Western banking system through credit default swaps. For the first time in history, incredibly safe money market funds broke the buck, meaning they actually lost value. Credit markets seized up, lending completely froze. Within days, the panic spread to London, Tokyo, Frankfurt, and Sao Paulo. The invisible plumbing of global money simply stopped working.
And you're probably wondering, what about accountability? Well, a leading expert in financial forensics, bankruptcy examiner Anton Valukas, published this massive 2,200-page autopsy report detailing the exact mechanics of the Repo 105 illusion. The evidence was all there. Yet CEO Dick Fuld, the architect of this entire toxic culture, walked away with $500 million in compensation earned during his tenure. He blamed short sellers, he blamed the government, he blamed literally everyone but himself.
And it gets even more unbelievable. The auditors, Ernst & Young, the experts who actively enabled this window dressing, they settled with New York in 2015 for just $10 million. And they did it without ever admitting wrongdoing. Almost nobody went to prison for this. The entire systemic failure resulted in some minor fines for the enablers, while the global economy basically burned to the ground.
Which brings us to our final section, Section 5, The Ghosts of 2008.
The bailouts that followed did save the financial system, sure, but as experts point out, they deeply poisoned the political one. The crisis destroyed public trust in banks, in regulators, and really in the idea of a fair system. This directly spurred political populism across the entire spectrum, from Occupy Wall Street on the left to the Tea Party on the right, and even fueled movements like Brexit. And mechanically speaking, the Dodd-Frank regulations were passed, but they've already been partially rolled back. The repo market, that exact mechanism Lehman exploited, it still moves trillions of dollars daily, largely in the shadows. The architecture might look a little different now, but the fundamental incentives, they remain.
Years later, while running a private capital group, Dick Fuld gave his first public speech since the crash, and he said, "Whatever it is, enjoy the ride. No regrets." Experts and historians who study Lehman emphasize this wasn't some grand mastermind conspiracy, it was just a culture of staggering arrogance. Fuld woke up every single day thinking he was the smartest guy in the room, and for 14 years, the board, the auditors, the regulators, and the investors all agreed with him. Until they couldn't anymore.
So, what does this all mean for us today? That $639 billion wasn't just money. It was the illusion that someone was watching, that the numbers actually meant something, and that 158 years of history kept us safe. Sure, accounting rules have tightened up since then, but if the fundamental incentive to hide risk and make the numbers look pretty for just one more quarter never really went away, is the illusion of safety still hiding the next collapse?